So, let's talk about something really important. Are you building your own wealth, or are you just making your broker rich? I know, it's a tough question, but it gets right to the heart of one of the biggest ideas in finance. What's the difference between an investor and a speculator? Figuring this out, well, it's pretty much the first step to actually taking control of your financial future. It's funny, the philosopher Blaise Pascal wrote this centuries ago, but man, does it hit home for the modern market. He's talking about this deep human inability to just sit still, to just be patient. And that right there, that's what leads us to make some of our absolute worst financial decisions. It's that itch, that feeling you have to do something, anything. And that's exactly what can turn a perfectly good plan into a total disaster. Okay, so have you ever noticed this? You see it on the news all the time. They cheer when the market soars, and they cheer when it crashes. They cheer no matter what happened that day. So what's up with that? Why? Well, the answer kind of reveals this fundamental conflict of interest that's right at the heart of Wall Street. And here's a big secret. It's because every single time you trade, every buy, every sell, it generates a commission or a fee for them. Your activity, that's their profit. So think about that. Your goal is to patiently build wealth over time. Their goal? To get you to do as much as possible, as often as possible. Those two things are completely at odds. So how in the world are you supposed to navigate this? Well, lucky for us, we've got a guide. The absolute legend, Benjamin Graham, laid out a framework for this decades ago that is, I'm telling you, more relevant today than it has ever been. He basically drew a sharp line in the sand between two totally different ways of thinking about the market. So this is Graham's classic definition. And it looks simple, right? But it's incredibly powerful because it gives us a really clear test. Notice what he's not talking about. He's not talking about finding the next hot stock or trying to time the market perfectly. No, this is a discipline. It's a set of rules designed to protect you from, well, yourself. All right, let's really break this down into three parts. First, you got to do your homework. You have to actually study the business itself. Second, and this is key, your main goal isn't to get rich quick. It's to not lose money. Protect that principle. And third, you're looking for a good, solid, adequate return, not trying to win the lottery. If what you're doing fails any of these three tests, guess what? It's not investing. It's just speculation. And this really brings us to the two big paths you can take. You've got the investor on one side. They figure out what a business is actually worth. And then they look at the stock price to see if it's a good deal. Seriously, they'd be cool if the stock market just closed for a year. Then you've got the speculator. They do the exact opposite. The market price tells them what something is worth. And that constant stream of stock quotes, that's not just info for them. It's like oxygen. They can't live without it. Now, getting these two paths mixed up isn't just some academic mistake, Let's take a look at what happened in the real world. In the late 1990s, pretty much an entire country forgot the difference. And, well, the results were an absolute catastrophe. 105%. So what does that even mean? Well, by 2002, the annual turnover rate on the New York Stock Exchange hit 105%. That means the average amount of time someone held a stock had shrunk to just a little over 11 months. People weren't investing in businesses for the long haul anymore. They were just playing a giant game of hot potato. And believe me, it got even more extreme than that. At the absolute peak of the dot-com bubble, the entire ownership of some of these companies was changing hands every few days. I mean, look at Puma Technology. The average shareholder held that stock for less than a week. This wasn't investing, it was basically a high-speed video game, played with real money. And of course, Wall Street was pouring gasoline on this fire, selling these fantasies of getting rich overnight. There was this famous TV ad back then for Discover Brokerage. It shows this regular tow truck driver who, through his savvy online trading, had bought his own private island. And the punchline? Someone asks him if it's an island, and he just coolly replies, "Technically, it's a country." The message was so clear. You don't need to know anything. You just need an online account, and you can be a millionaire. And this mindset, it just infected everybody. I mean, even the superstar Barbara Streisand admitted that her whole strategy was based on pure emotion. She said if she saw red in her profit or loss column, she'd just sell her stocks quickly. Think about that. It had absolutely nothing to do with the company's value or its earnings or its future. It was just pure speculation based on a color on a screen. Okay, but maybe nothing, and I mean nothing, illustrates the absolute madness better than this story. So Ticketmaster Online goes public, right? The ticker is TMCS.
Thousands of traders are frantically trying to buy it. But in their rush, a whole bunch of them bought TMCO instead, a tiny, completely unrelated building maintenance company. And that stock, TMCO, nearly tripled in minutes for no reason at all, except that people were buying so fast they didn't even know what company they were buying.
Now, a lot of this frenzy was justified by these so-called systems or formulas that promised you could beat the market with almost no effort. But let's be real, these quick buck schemes are just another form of speculation. Just speculation dressed up in a lab coat to look smart. I mean, just take a look at this popular strategy from the 90s. It was called the Foolish Four. The steps are just bizarre. You're supposed to find the 5 best stocks based on these criteria, and then you throw out the best one. And then you put 40% of your money in the second lowest price stock. I mean, why? It makes absolutely no logical sense whatsoever. And let's circle back to Graham's rules for a second. This Foolish Four strategy was actually sold as having minimal risk. But how could putting 40% of your money into one single stock ever be considered minimal risk? A portfolio with only 4 stocks completely throws the idea of diversification right out the window. And diversification is like rule number 1 for protecting your money. And you know what? It's a story that just keeps repeating itself. There was another famous formula from a book called What Works on Wall Street. The author even launched a bunch of mutual funds based on his supposedly time-tested strategies. But guess what happened? Almost right after the book came out, those funds just got crushed by the market. Turns out what worked suddenly didn't work at all. And this really shows you why all these mechanical, magic formulas are ultimately destined to fail. There are really only 2 possibilities. Either they were just based on random luck in the first place, or if they actually did have a real edge, the second they become popular, everybody piles in, and that advantage completely disappears. Boof, gone. All right, so if the frenzy of speculation is so dangerous and all these secret formulas are a dead end, what's the solution? Well, it's really about you setting your own terms. It's about drawing a very clear, very strict line between your serious money and, well, your fun money. Look, let's be realistic. That gambling instinct, it's a pretty powerful part of being human. Trying to just pretend it doesn't exist is probably a losing battle. And Benjamin Graham, he got this. The goal isn't to pretend you're some kind of emotionless robot. The goal is to build a firewall. And Graham gave us some really clear rules for how to do this. First off, you have to be honest with yourself. If you're gambling, call it what it is, gambling. Second, don't take it too seriously. It's a game, and you might lose. And third, this is maybe the most important part. Put strict limits on the amount you're willing to risk, and keep that cash in a completely separate account from your real long-term investments. Never, ever let them mix. So what's that strict limit he's talking about? Well, Graham suggested a rule of thumb that has really stood the test of time. You should never, ever put more than 10% of your total wealth at speculative risk. That's it. This is your mad money account. If it all goes to zero, yeah, it'll sting, but it won't completely derail your entire financial future. So this brings us right back to where we started. The next time you feel that itch to trade, or you want to chase some hot tip or follow some new can't-miss formula, just stop and ask yourself one simple question. Is this move based on a thorough analysis of a business that I actually want to own for the long run, or am I just making my broker rich? Because in the end, that choice is always yours.